Intangible Assets, IAS 38. Assets used on an ongoing basis within the business to generate revenue are referred to as non-current assets. An identifiable non-financial asset without a physical component is called an intangible asset. Key features of an intangible asset. It is a resource that the entity controls as a result of past occurrences from which the entity anticipates reaping future financial benefits. It is identifiable and distinct from goodwill and lacks physical substance. The fundamental principle of recognizing an intangible asset is that they must meet the definition of an intangible asset and meet the recognition criteria. Like any asset, it should be able to be measured reliably, and it is likely that future economic benefits will be realized during the asset's useful life. Development costs are intangible assets created internally that may be capitalized if certain requirements are met. Let us look into the classification of assets. Assets. Tangible non-current assets normally have physical substance, for example, land and buildings. Normally involve expenditure being incurred. Cost of the tangible non-current asset is capitalized. Depreciation is a reflection of the wearing out of the asset. Intangible non-current assets do not normally have physical substance, for example, copyright. Can be purchased or may be created within a business without any expenditure being incurred, that is, internally generated. For example, brands. Purchased intangible non-current assets are capitalized. Generally, internally generated assets may not be capitalized. Amortization is a reflection of the wearing out of the capitalized asset. Examples: development costs, goodwill, trademarks, licenses, patents, copyrights, franchises. Research and development. Research. Research is defined by IAS 38 as an original and planned investigation with the goal of gaining new scientific or technical knowledge and understanding. Development. Before the start of commercial production or use, development is the application of research findings or other knowledge to a plan or design for the production of new or significantly improved materials, devices, products, processes, systems, or services. When an entity engages in research and development, money is spent with the hope of generating future financial gains, such as higher sales revenues and profits. Accounting treatment of research and development. The accounting issue is therefore whether these costs should be expensed to the statement of profit or loss, or capitalized as an intangible asset on the statement of financial position to match against future benefits arising. Research. Every research expense should be expensed in the statement of profit or loss as it is incurred. Any investment in research equipment, including real estate, machinery, and equipment, should be capitalized and depreciated in accordance with IAS 16. Development costs. Development costs must be capitalized as an intangible asset under IAS 38 Intangible Assets if they meet both the recognition criteria and the definition of an intangible asset. Criterias that has to be met. These are the criterias that has to be met for development expenditure to be capitalized. Probable inflow of economic benefit from the asset, whether through sales or internal cost reductions. Intention to finish the asset and use it or sell it. Reliable measurement of development costs. Adequate financial and other resources to finish the project. Technical feasibility to finish the asset so that it will be available for use or sale. Expected to be profitable. The costs of the project will be exceeded by the benefits generated. Development costs must be written off to the statement of profit or loss as they are incurred if the stated requirements are not met. Subsequent treatment of capitalized development expenditure. The asset should be amortized over the expected benefit period. This assures that the revenue and costs are matched in the profit and loss statement. Amortization should start with commercial production and be charged over the time frame that the company anticipates generating financial benefits. Each project should be reviewed at the year end to ensure that the criteria are still met. If they are no longer met, the previously capitalized expenditure must be written off to the statement of profit or loss immediately. If a policy of capitalization is adopted, it should be applied to all projects that meet the criteria. IAS 38 Amortization of Intangible Assets. If an intangible asset's useful life is limited, the capitalized development costs must be amortized once commercial exploitation starts. The method of amortization chosen should be consistent with how the asset's economic benefits are consumed by the organization. The straight-line method should be applied if that pattern cannot be reliably identified. It is inappropriate to amortize an intangible asset with an indefinite useful life. If the amount of time over which an asset is anticipated to generate net cash inflows for the business is not known, it is said that the asset has an indefinite useful life. It should be the subject of an annual impairment review instead. Measurement of intangible assets. Initial recognition and measurement. An intangible asset shall be measured initially at cost, according to IAS 38 Intangible Assets. Subsequent measurement. IAS 38 allows for the use of either the cost model or the valuation model for further measurement. An intangible asset shall be carried at its cost, less any accumulated amortization and any accumulated impairment losses if the cost model is used. Valuation and cost model. Fair value must be determined in relation to an active market in order for the valuation model to be used. This means that the intangible assets must be homogeneous, that is, identical in nature. This is very unusual. As a result, the cost model is used to account for intangible assets. IAS 38 Disclosure Requirements. According to IAS 38, intangible assets, the financial statements should disclose the following for capitalized development costs and other intangible assets: the method used for amortization and the anticipated period of amortization, a reconciliation of the period's beginning and ending carrying amounts, the total amount of R&D expenses that were recorded as expenses during the time period. Reconciliation pro forma. The reconciliation for intangible assets required by IAS 38 is similar to that required for property, plant, and equipment in accordance with IAS 16. Let us look into the pro forma.